Are you considering buying a home but you aren't familiar with the current loan options? Well, there's 4 main loan programs, and understanding these can help you find the best fit for you and potentially help you save thousands of dollars. In this video, I'm going to be chatting with Jess Fischer, my preferred lender, and we're going to be talking to you more about these 4 programs, who might be able to qualify for them, why they're a good fit for you, and how you could potentially save thousands of dollars while using them. Stick around until the end, and we're going to be going over a few extra options that you might not have considered. If this is your first time to the channel, welcome. This channel is all about living in the Salida, Colorado area and the real estate market here. So if that interests you, please be sure and subscribe to the channel and hit the bell for notifications so you're the first to know when new informative videos become available. My name is McCarthy and I'm a realtor that specializes in Salida and surrounding areas. And I get calls all the time from people just like you who are looking to move here. So whether you're thinking of moving here in a few weeks or a few months, please reach out to me. All of my contact information is below, and I'd be happy to schedule a time to chat and help you make a smooth transition to the Salida, Colorado area. Okay, so like I said at the top, we're going to be talking about 4 main loan programs and giving you some insight into why you might want to use these and whether or not they're a good fit for you. So the first one we're going to talk about is the conventional loan. Give us, for somebody who maybe you haven't bought a house in a while or you're a first-time home buyer, give us some insight into what is this type of loan and who might be a good fit for it.
Yeah, conventional loans are kind of what most people generally think of getting a home loan.
Sure.
Usually Fannie and Freddie are the 2 kind of big lenders for that. They buy those loans and set the regulation for those loans.
Okay.
Conventional loans, typically good solid credit score. And I'll even say, potentially depending on the situation, even as low as like 620 and above.
Okay.
So, in the 700s, 800s, high 6s, typically pretty good option for people with a conventional loan. As far as needed down payment, the conventional wisdom is 20% down.
Yeah.
That way you get rid of the mortgage insurance that gets added on if you have less than 20% down.
Yeah.
However, if you're a first-time home buyer, you can get away with 3% down. And a key thing that a lot of people don't know about is being a first-time home buyer doesn't mean that you've never bought a home before. It just means in the last 2 years you have not bought a home.
Okay.
So kind of in our neck of the woods, some people come and they rent for a while to figure out best fit, what neighborhood they want to be in, all those kind of things. Well, if somebody does that for 2 years, then technically they could qualify for a first-time home buyer. Another way that somebody can qualify is if you and a spouse are going to buy a home and one of them have not bought a home in the last 2 years, then you can qualify for first-time home buyer. One of the kind of that's become more common, so it's worth mentioning here, is the idea of recasting.
Oh, okay.
So let's say, one of our previous videos, we talked about ways to purchase a home without selling your current home, or at least not having to sell your current home right away.
Yeah.
Well, lots of times there's equity in that home that's being sold.
Yeah.
So let's say you're putting $200,000 down to meet the 20% minimum on a conventional loan, and then you're going to sell your house. Well, hopefully you got equity in that house and there's going to be a big chunk that's coming your way. You can actually recast the loan. Most people only know about refinancing, but recasting is that then you're putting a large payment towards your loan, but with recasting, you're able to re-amortize the loan, so it brings down your monthly payment.
Oh, okay.
Yeah, so then you, instead of refinancing where you still keep that same payment or you have to take whatever the current rate is, this keeps your rate the same and you're actually able to bring down
Okay, so your rate stays locked, but it currently was, and you're essentially putting in, instead of like making a gigantic payment on your principal and then just keeping the exact same loan, you're recasting it so you can change it and actually have a lower monthly payment from here on out. That's great.
It is great, and we're seeing that to become a lot more common. And the reason why I bring it up is because we're going to talk about some other loans, which are mainly government-backed loans, which are fantastic loans and have a lot of benefits to them, but you're not able to recast with those.
Okay, yes, that's a good difference in understanding why conventional could be a good choice. And I don't think everybody realizes that you can be a first-time home buyer with a conventional loan. I think a lot of people think you have to do an FHA loan if you're a first-time home buyer, but you could still have a lower down payment with a conventional loan.
You can. Yes. Yeah, you can get away with it. It's no longer that required or minimum of 20% anymore. It's a lot more accessible. And so ultimately with a conventional loan, follows these kind of standard guidelines. It's really relatively simple to do, and it's a good fit for people that have W-2 income, Social Security income, retirement income, have a history of 1099 income, so self-employed, entrepreneurs, that kind of stuff. So really it's a pretty straightforward loan for the most part. It's a great product.
And I think it's the one that I know in working with sellers, oftentimes when they see an offer with a conventional loan, it feels a little bit more solid, right or wrong. That is a perception that a lot of people have in the real estate world. So when you're making an offer with a conventional loan, it tends to look stronger than another loan product sometimes. It depends on the whole picture, but it does come off as more solid. Whether or not that's true or not, we'll talk about, but from a perception standpoint, I see that.
Yeah, I think it's the conventional way to go.
Yeah.
And so, people are familiar with it.
Yeah.
They know, okay, their credit's got to be good. They're coming with a down payment. Their income fits, all those kind of things. There's an assumption lots of times that government loans are, government-backed loans, like FHA, VA, USDA, that kind of stuff, are for people that are less qualified or it requires more work and all that kind of stuff. And it's not necessarily true at all. It's just really finding the best fit for the individual.
100%, yeah.
But conventional loans have an idea behind them when you present that.
Absolutely. And then a little bit more because you mentioned PMI. So for anybody who doesn't understand what that means real quick. So that's where the 20% down payment minimum is coming from, that perception. Explain what that means.
Yeah, so if it's 80% loan to value. Okay. So if you're buying $1 million house, you put $200,000 down. So you have an $800,000 mortgage. That's 80% of the value of the home.
Yeah.
Right? So you get rid of mortgage insurance. If you're anywhere in between there, then you have to pay mortgage insurance. Essentially is like, it's not a penalty, it's more just an assurance that to the lender. Because the lender always looks at things through a lens of risk.
Okay.
Right? So if you have a smaller down payment, your loan to value is smaller, is higher, I guess. They're like, okay, are they going to be able to make their payment? Or are they not? You know, kind of thing. Whereas you have that 20% gap, there's a little bit of assurance there that it's going to be okay and they can make their payments and all that stuff. So the mortgage insurance is there, but it automatically, one of the nice things with the conventional loan is at 79% loan to value, it drops off. At 80% as the owner of the home, you can contact the lender and say, hey, I believe I'm at 80% loan to value. Can we drop the mortgage insurance? And it can happen a little bit faster than most people think because as you're making your monthly payments, your overall loan is going down and depending on the area that you're in, but historically the value of your home will rise. So that you're working on both ends to get to that 80%.
So if you bought in Salida, Colorado in the last few years, you're likely going to have an increase in value. Yeah. And that'll likely continue to happen, by the way. Yeah. But also the PMI becomes part of your monthly mortgage payment. So you can get rid of that. Your monthly mortgage payment will go down as well. So that's why a lot of people choose to do that.
And it affects your debt to income because that does go into the debt to income calculation as well too.
Gotcha.
So if you can get rid of mortgage insurance, that can help your debt to income.
Yeah, definitely. But you don't have to, the whole point is you don't have to have that 20% down. You could have 3%, like you said. Okay. Yep. Perfect. Okay, so the next loan product we'll be talking about is an FHA loan, another one that I think a lot of people know about, but give us some more insight into that one and who might be a good fit for it, especially if choosing this one over a conventional. Why would you choose an FHA and how does that work?
Yeah, we'll talk about kind of typically, and then we'll talk about there's some instances recently that kind of gave a little shake up to is conventional or FHA better. But with the FHA loan, typically on the lower credit side is the first thing that I look at. Okay. Is if somebody's on the lower credit side, the mortgage insurance won't be as bad as a conventional loan. So if the mortgage insurance is affected by your credit score. Okay. So on a conventional loan, if you're kind of maybe on the lower end, it may make sense to do FHA because the mortgage insurance is just going to be just too large. With the FHA as well too, first time home buyer 3.5%. Okay. Instead of the 3%. Okay. With the FHA as well too, one of the downsides to it is you've got to pay an upfront mortgage insurance, and it can be a significant amount. But the benefit of it too is you can roll that into the loan. Okay. As well. So there's some flexibility with that. It's not that you have to come with thousands of dollars. Actually, you can actually roll that into the loan. A benefit of the FHA that I do see is the ability to streamline refinance. So if you're going to go to refinance in the future with a conventional loan, it's almost like you're buying the house again. The documentation, paperwork, timing, all that stuff. With the FHA, it's just a little bit more.
Okay, there you go.
But yeah, with the streamlined refinances, it's just very simple. There's very little to do.
That's good to know. So if you're buying, I know people are kind of, when are rates going to go down? And they've been slowly going down, but not as much as we would have hoped, but they likely will. So you're buying right now we're in the mid 6s, but you can refi later as it will hopefully be down. Okay.
With FHA loans too, the interest rate is lower.
That's true. Yeah.
So it really just becomes a math problem when you're looking at having having to pay upfront mortgage insurance. Also, the mortgage insurance doesn't go away as easy. So you may be paying for a significant life of that loan, that mortgage insurance. And so kind of doing that math with the lower rates versus a conventional loan.
Okay.
Oftentimes what I find is if you exclude the upfront mortgage insurance, lots of times, even though the rate is lower with FHA, the payment's about the same as a conventional. So the reason why I bring that up is a lot of people get focused on rate. I got to get the lowest rate. I got to get the lowest rate. It's just one piece of the story.
Yeah.
And working with a good lender that's going to help explain that and actually do the math to see from a cash flow standpoint or a long-term standpoint, is this the best fit?
Totally.
I ask all my clients, is this a 3-year house, a forever home? Is this a stepping stone? Because that changes what loan program is going to work best for them.
Totally. Yeah, that makes a lot of sense. So the next one we'll talk about is a VA loan. So explain that one and who might qualify.
Yeah, so active duty and veterans qualify for the VA loan. If a veteran's got any disability rating, then they don't have to pay the fee up front. So that can be a really huge help when you're going to not only purchase a home, but also to refinance. You don't have to pay the funding fee, which is a good benefit.
Yeah.
The biggest benefit with the VA loan is you can get 100% financing. So you can potentially come with no down payment on there. I would say overall, out of all the loan programs, probably the best loan program, or maybe even the best two, is a VA loan and a USDA loan if somebody can qualify for it. One thing worth mentioning here, because I am seeing this more often with the VA loan rates are better as well too. So they fall more along lines of FHA, lower. If you it's not apples to apples, but if you think about conventional loan and let's say it's 6.25, you can roughly guess that a VA loan is going to be 5.5 or lower. Significant benefit there.
Yeah.
You can also streamline refinance a VA loan, which is another significant factor. Closing costs are less, all those kind of things, as long as you don't have to pay the funding fee, because you always have to pay the funding fee if you don't have a disability rating. But the one thing that I've been seeing quite a bit is in the past, it was really thought of only the veteran or the spouse can be on the loan.
Okay.
You can actually have a non-occupying co-borrower on a VA loan, which even today, a lot of lenders don't know that that's possible and that you can do that. So essentially where that comes in is somebody who wants a co-signer. That can really help out, in particular with how high home prices are.
Yeah, that's huge.
It can be a huge help to people.
And so it doesn't have to be somebody who's also a veteran or their spouse. It could be like a parent or somebody else.
A non-occupying co-borrower that's not a veteran, that's not a spouse. That used to think the conventional wisdom was that you couldn't do that, but you can do that, and I've actually been seeing that quite a few instances over the last.
Yeah, that makes sense. And then the fourth one would be a USDA loan, which you sort of alluded to a moment ago. So explain a little bit more about what that one is and who could qualify.
Yeah, USDA loans are fantastic loans. You can get 100% financing with USDA loans. I think a lot of people think of USDA loans like ranching or somewhere far away, but it doesn't have to be that. I mean, even in Salida, in the surrounding areas, you can get a USDA loan. The biggest trick with the USDA loans, they have great rates too, like FHA and VA, better than conventional rates. And essentially the reason why is because it's backed by the government. So there's some assurances there, so the rates are lower. But the problem that we run into in Colorado with USDA loans is there's income limits. So you have to be under a certain income threshold. I believe right now 1 to 2 person income is like 100 and I'll just say give or take a couple thousand, 120,000. Well, when you look at the price of homes in Colorado, it's very hard for a lot of people to find what they want with a $120,000 income and be able to qualify from a debt to income standpoint because of the price of the home and the current rates being so high. So the slice of the pie to be able to not only qualify for the USDA loan, but make it work to buy a home here is very narrow. But it's definitely worth looking into if you kind of fit that and you find the right place, because it's another fantastic loan like the VA loan. In a lot of ways, it kind of mirrors the VA loan as far as, the flexibility and what you can do with it.
So definitely worth looking into.
Definitely worth looking into. I would say 1 to 2 out of every 10 borrowers that are looking into USDA loans actually can make it fit in Colorado. In particular in this area. There's other places in Colorado that would definitely work and would fit. But in these kind of higher priced areas that we're in, high demand areas, it's very challenging.
Yeah, so Salida, where we both are, is a median home price of around $650,000 to $700,000. But Jess also works in all of Colorado, so there could be other areas, more rural areas, that are not at that high level of median price point that this could work for.
100%, and it's a fantastic loan.
And then we kind of alluded to the top, so after those four, those are kind of the main ones, but there's a few other non-conventional options we'll kind of pepper in right now, give you some teaser about, so elaborate or give us some insight into some of those.
Yeah, so, in a couple of other videos that we've done, we've kind of expanded on it a little bit more. But I see profit and loss statement loans, so people that own their own businesses, entrepreneurs, self-employed, that kind of stuff. Essentially, it's 1 year of profit and loss. You get the statement filled out by your tax advisor, CPA, accountant, whoever it is, and that can qualify somebody for a mortgage. The other one is bank statement loans. So where I typically see bank statement loans come in is people that, maybe they don't get paid the 15th and the 30th, of every month or whatever, and they have this kind of more sporadic, because that's pretty typical for whatever business that they're in. That, normally when you think about conventional loans, that's that W-2, you get it every 2 weeks or every month, and it's very dependable, reliable. Well, underwriters will look at bank statements and they'll see cash flow coming in and out, and then they calculate income based there. So been doing quite a few of the profit and loss of bank statement loans. Been seeing quite a bit of asset depletion. In other words, these are retirees that have income, but they're not taking distributions from their 401k or IRA. There is a calculation that can be done to essentially generate income even though they're not taking any distributions. And that can be really helpful, especially retirees that, you got to be past the 59 and a half age, but that they are just maybe not ready. Maybe they want to wait till they're 65 or 72 or whatever it is. So you don't actually have to take that income for it to be calculated. The other one is just distribution income. So they're collecting Social Security, and they're taking X amount of money as distribution from their account, from their retirement account. You can do that. And then not many people know about this as well too, but if somebody's taking distribution, you can count their distribution income and then what's left over. So for simple math, they have $100,000 in their account, and on average they take $30,000 a year from that $100,000. They probably have a lot more than that, but we're just doing simple math here. So that leaves $70,000 still in their account that they don't basically touch each year. You can count the distribution income, and then you can do the asset depletion on the 70% that they don't take and generate income from that. So from one account, you can do two different calculations to create more income. So that's been something that's been used as well too.
That's right. And we talk more about those last three. We have a video about basically purchasing a home as a retiree, and then the other ones we talked about were more related to self-employment. And so we have a separate video about loans for when you're self-employed. So we elaborate on those a little bit more, but that just gives you a teaser here. When
rates are higher, lenders get more creative, right? Because they're not getting as much business because rates are higher. And so it opens up these things like bank statement loans, profit and loss statements, asset depletion, distribution income, all that kind of stuff.
That makes sense. So there are options is really the whole point of this. And so, talk to Jess or a lender near you to learn more about what works best for you. We say this all the time, but get pre-approved early in the process so you can understand what all of your options are. So when you're ready to talk with somebody like me to help you buy a home, you're in a good place and understand your budget. So thank you so much for giving all of that information to us. If you have any questions about the home buying process or getting a loan here, please reach out to one of us. All of our information is below. And thank you so much for watching, and have a good day.